I have watched retirement savings evaporate through tax code changes before, not through market crashes or bad investments, through deadlines that were never announced clearly and penalty structures that activate automatically when retirees miss requirements they did not know existed. The Internal Revenue Service implemented new rules in 2026 that fundamentally restructure how retirement distributions are taxed, how deductions are calculated, and how penalties are assessed. Most retirees will not hear about these changes until they file their 2026 tax return and discover they owe thousands in penalties for violations they committed unknowingly. By then, the damage is permanent. This is not speculation about future policy. These rules are already in effect. The deadlines are set. The penalty structures are codified. And approximately 47 million Americans over age 65 are operating under assumptions about retirement tax law that are no longer accurate. The first change involves a new deduction that was added quietly to the tax code in late 2025. It is called the Senior Bonus Deduction, and it provides an additional $6,000 in tax deductions for individuals over 65. For married couples filing jointly, the deduction is $12,000. This is not a replacement for the standard deduction. It is an additional amount that reduces taxable income on top of the standard deduction. For a single retiree taking the standard deduction of $14,600, the total deduction becomes $20,600. For a married couple, the standard deduction of $29,200 becomes $41,200. That additional deduction reduces federal income tax by approximately $1,320 for single filers and $2,640 for married couples. But the deduction disappears entirely if your income exceeds specific thresholds. For single filers, the threshold is $75,000 of adjusted gross income. For married couples filing jointly, the threshold is $150,000. And the phase-out is not gradual. It is a cliff. $1 over the threshold and the entire $6,000 deduction vanishes. This creates what tax professionals are calling a dead zone. A retiree with $74,999 of income gets the full $6,000 deduction. A retiree with $75,001 of income gets nothing. That $1 of additional income just cost them $1,320 in additional federal tax. The cliff structure means retirees need to manage their income with precision. Taking one extra retirement distribution, selling one investment at the wrong time, or receiving one unexpected bonus payment can push income over the threshold and eliminate the deduction. And because adjusted gross income is calculated before deductions, retirees cannot simply contribute more to charity or make other deductible payments to get back under the limit. Once AGI crosses the threshold, the deduction is gone. The second change involves catch-up contributions to retirement accounts. For decades, workers over age 50 have been allowed to contribute extra amounts to 401k plans and IRAs beyond the normal limits. These catch-up contributions were always pre-tax, meaning they reduced current taxable income and grew tax deferred until retirement. Starting in 2026, the rules changed for high earners. Anyone whose wages in the previous year exceeded $145,000 can no longer make pre-tax catch-up contributions. All catch-up contributions for these individuals must go into Roth accounts, which means they are made with after-tax dollars. A worker aged 55 making $160,000, who contributes the maximum catch-up amount of $7,500, will no longer receive a tax deduction for that contribution. Instead of reducing their taxable income and saving approximately $1,650 in federal tax, they must pay tax on the full amount and contribute to the Roth 401k with after-tax money. The rationale behind this change is revenue acceleration. The government wants tax payments now rather than waiting decades for retirees to withdraw money from traditional retirement accounts. But the impact on take-home pay is immediate. The third change involves required minimum distributions. RMDs are the mandatory withdrawals retirees must take from traditional IRAs and 401k accounts starting at a specific age. Under the Secure Act 2.0, the age increased to 73 for people born between 1951 and 1959, and 75 for people born in 1960 or later. But the transition created confusion. A retiree born in 1952 turned 73 in 2025 and must take their first RMD by April 1st of 2026. But April 1st of 2026 falls in the same calendar year as their second RMD, which is due by December 31st of 2026. That means they must take two distributions in 1 year, doubling their taxable income and potentially pushing them into higher tax brackets and triggering Medicare premium surcharges. The penalty for missing an RMD is 25% of the amount that should have been withdrawn. If your RMD is $20,000 and you fail to take it, you owe $5,000 in penalty on top of the regular income tax. The fourth change involves inherited retirement accounts. Prior to 2020, beneficiaries who inherited an IRA could stretch distributions over their lifetime. The Secure Act eliminated that option for most beneficiaries. Now, non-spouse beneficiaries must empty the inherited account within 10 years. But the IRS recently clarified that for beneficiaries who inherited accounts from someone who was already taking RMDs, the 10-year rule includes annual distribution requirements. You cannot wait until year 10 and take everything at once. You must take distributions every year based on the original account owner's RMD schedule. And if you miss one of those annual distributions, you face the 25% penalty on the amount that should have been withdrawn. This creates a trap for heirs who thought they had flexibility. Adult children who inherit a parent's IRA and assume they can let it grow for a decade before taking distributions are violating the rules. And many will not discover the violation until they receive a penalty notice from the IRS years later. The fifth change involves Medicare premium surcharges. Medicare Part B premiums are income-based. The standard premium for 2026 is approximately $174 per month. But retirees whose modified adjusted gross income exceeds specific thresholds pay substantially more. The surcharge is called IRMA. For single filers, IRMA kicks in at $103,000 of income. For married couples, the threshold is $206,000. Cross that threshold by $1 and your monthly premium increases by approximately $70 per month, or $840 per year. The surcharges scale up in tiers, with the highest tier requiring monthly premiums over $600. The problem is that IRMA is calculated based on tax returns from 2 years prior. Your 2026 Medicare premiums are based on your 2024 tax return. That creates a mismatch where retirees who had one-time income spikes face higher Medicare premiums years later even though their current income is lower. And IRMA interacts with RMDs in ways that compound the cost. A retiree who turns 73 in 2026 and takes their first RMD sees their income increase. If that increase pushes them over the RMA threshold, their Medicare premiums jump in 2028. Meanwhile, their RMD amount increases each year as they age, gradually pushing them into higher IRMA A tiers. The sixth change involves Social Security taxation. Up to 85% of Social Security benefits can be subject to federal income tax depending on your combined income. The thresholds have not been adjusted for inflation since 1984. For single filers, the threshold is $25,000. For married couples, it is $32,000. Above those amounts, up to 50% of benefits are taxable. At higher thresholds, up to 85% become taxable. Most middle-income retirees pay federal income tax on the majority of their Social Security benefits. When combined with RMDs, this creates what tax professionals call the tax torpedo. Required distributions from retirement accounts increase adjusted gross income, which increases the portion of Social Security that is taxable, which increases overall tax liability. The effective marginal tax rate can exceed 50%. And because Social Security cost of living adjustments increase benefits annually, more retirees are being pushed into the taxable range each year. What was designed as a tax on high-income retirees in 1984 now affects the majority of people receiving benefits. There is one provision that provides relief, but only if retirees know about it and use it correctly. Qualified charitable distributions allow individuals over age 70 and a half to transfer up to $105,000 per year directly from an IRA to a qualified charity. The distribution counts toward the RMD requirement, but is not included in adjusted gross income. This is significant because excluding the distribution from AGI means it does not increase the taxable portion of Social Security, does not trigger IRMA surcharges, and does not push income over the cliff threshold for the senior bonus deduction. A retiree who takes a $20,000 RMD sees their taxable income increase by $20,000. A retiree who directs that same $20,000 to charity through a QCD sees zero increase in taxable income, while still satisfying the RMD requirement. But the QCD must be executed correctly. The distribution must go directly from the IRA custodian to the charity. If the retiree withdraws the money and then donates it, the distribution is taxable. The procedural requirements are strict and mistakes are not correctable. There's also a special catch-up provision for individuals aged 60 to 63. The normal catch-up contribution limit for 401k plans is $7,500. But for individuals in that specific age range, the limit increases to $11,250 for 2026, with plans to increase further to a maximum of $35,750. This is called the Super Catch-Up, and it provides a brief window for pre-retirees to accelerate retirement savings. But employers are not required to offer it. Many 401k plans have not been amended to include the higher limits. All of these changes are occurring simultaneously in 2026. The senior bonus deduction with its cliff phase out, the Roth mandate for high earner catch-up contributions, the RMD age transition creating double distribution years, the inherited IRA annual distribution requirements, the IRMA surcharges compounding with RMDs, the Social Security tax torpedo, and the QCD opportunity that most retirees do not know exists. According to early indicators from tax preparation firms, fewer than 15% of retirees over age 70 are aware of the new inherited IRA rules. Fewer than 20% know about the senior bonus deduction, and fewer than 30% have calculated whether their 2026 income will trigger IRMA surcharges in 2028. This is not accidental. The tax code has become so complex that compliance requires professional assistance most retirees cannot afford or do not seek until after mistakes have been made. And the IRS does not provide advance warnings. Penalty notices arrive months or years after the violation occurred. The emergency is not that the rules are unfair. The emergency is that the rules are in effect, and most retirees will not learn about them until penalties are assessed. The next tax return could trigger consequences that last for years. And the knowledge gap between those who understand these changes and those who do not is creating a two-tier system where informed retirees preserve wealth and uninformed retirees lose it to penalties and missed opportunities.